Welcome to my webinar. I'm John Fazio, and I have decades of experience in starting, growing, and turning small businesses around. As part of every phase of business, capital is a key component. I have raised, borrowed, and earned hundreds of millions of dollars. A major cause of small business failure, according to the SBA, is lack of sufficient capital. This is, in fact, a leading cause of small business failure. You are going to learn all about getting capital for your business and making your business more profitable in this webinar. I have always been an entrepreneur and I always will be. I have a passion for small business and want to help other entrepreneurs succeed. I have seen too many times small businesses fail when a few simple techniques or connections would have saved them. Things they just didn't know were easily available to them. At the end of this webinar, I will share a link to a free tool that will help you identify what types of loans you will qualify for. My laser loan targeting tool will save you hundreds of hours and endless frustration and failure in getting a loan. Can I tell you a story? In 2008, I was going through a difficult financial time with my environmental business. The Great Recession hit the environmental remediation industry hard. Environmental remediation work is closely tied to the housing and construction market. Housing and construction spending in 2007 to 2010 were at the lowest point since the Great Depression. I had to learn two things at that time to survive: how to turn my business around and get the capital to do it. These were dark days with creditors calling and contracts being postponed or canceled, mostly canceled. The contracts we did have were cutting back on spending just when we needed every penny. This went on for several years, trying to stay afloat. It was agonizing getting through each day. I knew a key to success was getting loans, and I did learn all about how to raise and borrow capital. I also learned the hard way what it takes to turn a business around. What I found was that I was very good at getting capital and making a business more profitable. I formed two new successful businesses after that. One was Winnie Advantage. I wanted to help other small business owners with starting up, growing, and turning their businesses around to be more profitable. I also wanted to help them get capital to do it. I have helped other companies since then get loans and raise capital to give them an opportunity to succeed in their business. I have also helped many companies become more profitable. I helped raise $3 million for an entrepreneur to start a fitness studio. I was able to get a startup telecom company a $5 million credit facility to grow their business. I was able to get a small developer a hard money loan for $2.7 million to settle other financing. I was able to help two IT companies merge and create a common culture. I recently helped a small staffing company get over $800,000 in PPP to overcome a downturn in business due to COVID-19. I've helped dozens of other small businesses get smaller loans to start their business or to overcome cash flow issues. Do you know the best options for funding your business? By the end of this webinar, you are going to know what options are available to fund your business. You will know the best path forward for your business funding. So let's get started. Something I think you've probably all heard before is that 80 to 90% of small businesses fail, usually within 5 years. Top reason, or one of the top reasons, is lack of capital. Why do companies need capital? This seems like a silly question, but companies always need capital for a wide variety of reasons. Some of the most common are growth, cash flow bridge, expansion of the business including acquisitions, and turnaround funding. There are four basic sources of capital and four types of capital. When you understand the sources of capital, it becomes easier to understand the way to obtain it. This is an easy-to-remember chart to remind you. Loans are from debt instruments, earnings come from profits, equity comes from investments, and for our purposes in this course, asset sales are derived from either current or future receivables. Hard assets could also be sold to generate capital, but that would be for retrenchment of the business in most cases, unless the sale was for a non-performing asset. So, there are 4 types of capital in general terms. They are debt, equity, earnings, and asset sales. There are pros and cons to different types of capital. The basics are that debt or loans need to be repaid with interest, while equity and profits do not need to be repaid. Equity capital requires giving up part of the company, essentially a sale of part of the company. This means shareholders generally get a share of profits. Capital from profits can be accumulated as retained earnings, a pool of capital to be used by the company. The development of a profitable business may make other types and sources of capital unnecessary. I just want to say that the asset sale seems to be a great deal since all the negatives are no's. However, in most cases, this will prove to be the most expensive capital. We will discuss this a little bit later. Here is our chart again on the basic 4 types and sources of capital. There are 4 main sources of capital. These are general categories of capital, and each form can have various levels of complexity. We will explore some of the various forms of each source of capital. The 4 sources of capital are loans, profits, investments, and asset sales. The best form of capital depends on the company and owner's situation, but in general, generating capital through profits is the best for obvious reasons. No payback, no interest, and no dilution of owner's interest. Mergers and acquisitions are a type of asset sale. In a merger, the acquiring company may get an injection of capital in addition to the purchase price. In some cases, when acquiring a company, the purchaser can raise or borrow additional capital to operate the company, working capital. This borrowing is based on the assets and/or cash flow of the acquisition. Debt capital is in the form of some type of loan, requiring payback and interest. There are a variety of types of loans, which we will review on the next slide. Here is our chart again on the basic 4 types and sources of capital. In this section of the presentation, we refer to certain asset sales as loans. This will serve our purpose here, but keep in mind these are actually sales of assets. Purchase order financing, merchant cash advance, MCA, and factoring are examples of a sale of future receivables. People sometimes ask me how these types of loans can charge such high interest. Isn't it usurious? Well, what is happening in a transaction like this is the one party is buying the asset from the business at a discount. This is how they get around the usury laws. Here are the basic types of loans. A conventional loan. This is a standard loan with interest and principal payments over a period of time, generally with equal payments, but other structures are possible, as in the case of a balloon payment. Credit line. This is a type of loan that is interest plus small principal payments, generally with the option of paying the principal down and reborrowing it again at will. A credit card is a type of credit line. Factoring. This is a purchase of invoices and not really a loan. Payment terms are generally within 90 days and rates are high on this type of instrument. The funding is based on the customer's good credit, not the borrower. Purchase order financing. Purchase order financing is just what it says and is generally based on the customer's good credit. The rates for this type of funding are high. Contract financing, an advance to purchase materials and services related to the production of a product a customer has ordered under the contract with the company. MCA or merchant cash advance is a cash advance against expected historical sales of the company. These are high-cost instruments where the company sells the future sales of the company. Cash flow loans are often associated with small loans based on the income of the company and/or owner. This type of loan is sometimes available as part of an SBA loan or for acquisition of a company. Preparation for a loan. Here are the most important areas to focus on when seeking a loan. Credit scores for the company must be satisfactory for more established companies. The credit score of the owner must be good for smaller, less established companies, since the owner will need to guarantee the loan. Collateral. Almost all loans require some form of collateral. The collateral should be valued by a reputable valuation expert to satisfy the lender. Cash flow. Well-documented cash flow is required for both cash flow loans and other types of loans. Lenders want to make sure the borrower has the necessary cash flow to service the loan. Guarantor. When the credit of the company or owner is not sufficient to get the loan, a guarantor with good credit can be used to bridge the insufficiency in some cases. This is a discussion of the quick ratio. You may know this already, but I just want to go over it to make sure. There are a variety of factors that lenders take into consideration when evaluating a loan request. We will look at one of the most important here, the quick ratio. This is the ratio of current assets divided by current liabilities. Lenders will generally want the ratio to be 1 or better after the loan is included in the current liabilities. This means the company could pay off the loan quickly by liquidating current assets. This chart describes the maximum debt capital that a company can get. When evaluating the maximum amount a company can borrow, the quick ratio is a good starting point. This chart shows that when current liabilities and current assets are equal, that is the maximum amount that could be borrowed, barring other criteria. We're going to take a look at some examples of different types of loans. Not all types of loans. There are many hybrid types of loans, but these are just general types of loans that we're going to take a look at here. This is an example of contract financing for a manufacturing company. Russell Bobo is second-generation owner of Bobo Engineering Incorporated, a contract manufacturer that specializes in cable assemblies, wire harnesses, and electromechanical assemblies. Bobo Engineering does manufacturing work for a variety of different businesses, including medical, fire, and defense industries. Working with diverse clientele means that Russell and his team need to have constant supply of machinery and inventory on hand. Since most of the projects Bobo Engineering works on are large scale, they need plenty of cash flow to complete projects and pay employees before they receive payments from their customers. Because of the nature of his business, Russell needs to have large sums of cash easily available and accessible as soon as a contract is received. The need for cash was exactly what made Russell start his search for an engineering loan. He required a lender that was willing to work with him on a flexible payment schedule and supply funds quickly. After receiving an engineering loan, Russell could take on more projects without worrying about cash flow. Russell has received funds on 5 different occasions to cover the costs of new work. Now, this is a situation where he found a specific bank, and this refers to engineering loan or contract financing of some sort, and it's probably it's either factoring or it could be purchase order financing type of loan that we talked about. This is an example of a merchant cash advance loan, which is, like we said, it's not really a loan, it's the sale of future receivables. This one worked out, although these are sometimes hard to get to work because they're expensive. In this instance, it was good, and so you can't rule out MCAs even though they're very high cost. So Dixon Schreffler's passion for the retail industry began when he was 16 years old, working at a Florida supermarket. In 1988, Dixon received an opportunity to purchase a small consignment shop, and he took it. Nearly 30 years later, Dixon has expanded his business to 2 different locations in Charlotte and Gastoria, North Carolina. After moving his Charlotte-based business into a large warehouse in 2008, Dixon was among many business owners who were struggling due to the country's economy. Dixon got a merchant cash advance loan. Dixon has used MCAs on 10 different occasions, and each time the amount of financing has increased. Most recently, Dixon received $120,000 to use towards his online and advertising presence. So this has worked out for him. You need to be careful with these. Notice he's paid them off at a certain point, and then he's gotten a new loan. So these are the kinds of loans that you don't want to have for too long. You want to get them paid off, and then you don't want to have to get a new one right away. Okay, so this is an example of a conventional loan, and this is for consulting business. So a lot of times people think they can't get a loan for their consulting or professional services business, but you can in certain cases. Rodney Thomas is the chairman and CEO of Thomas and Herbert Consulting. His consulting business specializes in IT management consulting for the federal government, state and local government, primarily in Washington, D.C. area. Rodney Thomas and his partner serve organizations such as the Department of Veterans Affairs, Department of Housing and Urban Development, and other civilian DoD agencies to improve the way they do business through the use of information technology. In July of 2013, Thomas and Herbert Consulting was the first small business in the world to be awarded a contract with the General Services Administration company Alliant Enterprise. The start of this new contract meant that Thomas and Herbert Consulting would be in need of some short-term working capital to get them started in their new venture. In early August, Rodney started his search, seeking out working capital to benefit his growing consulting business. With a small business loan, Thomas and Herbert Consulting was able to get on board and manage new clients through their GSA Alliant Enterprise contract. So I don't know exactly the loan that this guy got, but it sounds a lot like maybe it was a small business administration loan. And those are sometimes some of the best loans. We'll talk about that in a little bit. Equity capital requires that the owners of the company sell all or a portion of the business. This may only generate capital for the owners, not the company, unless the shares are sold from company treasury. Here is our chart again on the basic 4 types and sources of capital. Equity capital is obtained when one party buys a share of the business, which is called an investment. There are many types of equity instruments, which is well beyond the scope of this course, so keep that in mind for the future. Most people believe that when investing, an investor can only get common stock, which is not true. Some instruments are hybrids, being part debt and part equity. This is a discussion of the basic types of equity. There are a variety of equity sales structures. Here are the more common ones. Common stock is generally the sale of shares of the company with certain rights. The rights may include voting rights or not. Preferred stock is preferred because in the event of liquidation of the company, preferred shares are redeemed first before other equity instruments. These shares sometimes bear interest and generally do not have voting rights. Convertible debentures are generally interest-bearing debt instruments that are convertible to common shares. Safes and KISS instruments are simplified notes that are convertible to shares at a discount. These generally bear interest. They may or may not have a cap on the future value of the stock. Safes means a simple agreement for future equity, and KISS means keep it simple security. These may not be recorded as debt on the balance sheet. A membership interest is in use in partnerships and LLCs and operates much like shares for our purposes here. Here are some examples of some private equity investments. Here is our first example of a private equity investment. After 11 years, the world's largest private equity firm is checking out of one of the world's largest hospitality companies in what will be known as perhaps the best private equity profit ever made on record. Blackstone Group announced it would sell its remaining 5.79% stake in Hilton Worldwide Holdings in a sale worth an estimated $1.45 billion based on Hilton's closing stock price at the time. Hilton plans to repurchase 1.3 million of the total 15.8 million shares being sold by Blackstone. It has been a spectacular partnership with Blackstone, Hilton CEO Christopher Nassetta had said. They bought the company in 2007 at the peak of the buyout business and going into the Great Recession. It was fair to say, if you want to go ahead and read the headlines back then, it didn't look pretty. Everyone thought it was a bust. It was the biggest private equity check ever written. Everyone said it would be the greatest private equity loss in history. It's now the largest private equity profit ever made. So this is an example of a really positive deal in private equity. Here's our second example. This is a mergers and acquisitions deal. And you may have heard of it, Disney and Pixar. In 2006, Walt Disney Company acquired Pixar for $7.4 billion. Since then, movies such as Finding Dory, Toy Story 3, and WALL-E have generated billions in revenue. 3 years after the Pixar acquisition, Disney CEO Bob Iger set out to acquire Marvel Entertainment for $4 billion. Considering 11 Marvel movies have brought in more than $3.5 billion since the acquisition, and is a good example of successful acquisition across all fronts. So, this is the kind of deals that, equity deals that can be made. Here are a couple of deals, examples of deals on the public market. These are OTC markets because these are, OTC market is for smaller companies, so that's probably, if you were going to entertain it, that's probably the market that you would go on. So here are some successful offerings on OTC markets, the over-the-counter market in the United States for smaller offerings. Okay, we're going to talk about a couple of public companies that have raised capital through a public offering or reverse mergers sometimes. So one of them is Nestle. There's a bunch of companies that are on OTC markets that are fairly large. So some of the world's largest companies are actually listed on the OTC, such as Russia's Gazprom, the world's largest producer of natural gas, and Swiss food and beverage giant Nestle. Others include Alliance, BASF, Canadian Oil and Sands, Danone, Deutsche Telekom, and Roche. There's a couple of other U.S. companies, including Computer Services and Liquid-Tech. There are many others too. These are just a few examples. So here's an example of a company you may not have heard of them called Walmart. Lest you think OTC market companies are made up of tiny little businesses who never made it into the NASDAQ or NYSE, consider this. One of the larger companies listed is Nestle. We talked about them. And another big company we've all heard of is Walmart, who years ago started life as an OTC listed company. By 1972, Walmart had earned over $1 billion in sales, the most quickly a company has ever accomplished this. Shortly thereafter, Walmart listed on the New York Stock Exchange under the ticker symbol WMT. According to OTC Markets, 300 companies have graduated from the OTC financial marketplace to NASDAQ and NYSE, or another market. Other successful companies listed on the OTC markets are, again, Alliance, BASF, Danone, Deutsche Telekom, Roche, Computer Services, and Nobility Homes. So don't discount being able to raise capital on the OTC. Now this takes a lot of work and it's, not for the faint of heart, but you can do it. And some of these companies have done it. So whatever type of capital that you are trying to raise, you need to be prepared. So preparing for capital is really, it's an endeavor. So when seeking capital, it is important to prepare the company. Lenders and investors only put money into companies that are prepared well. Okay, so when you're seeking an investment, you need to get prepared. You need to prepare for an investment. When preparing for the investment, these are some of the most important areas that need to be conveyed to the prospective investor. Profitability is perhaps the most important. Investors are most interested in traction, meaning that there has been a significant proof of concept. This can best be demonstrated by the company having sales and profits for a period of time, usually about a year, but sometimes shorter for smaller capital raises. Sales over a period of time show how consistently the products and services have been moving, and the best type of sales are those from recurring purchases. Moat. The moat, like that which surrounds a castle, is an important concept investors like to see. It represents the idea that there are barriers to entry into the space that the business product service occupies. This can also be identified with differentiation of the product service. Other means of differentiation include patents and copyrights. Team. This is, in the mind of many investors, the most important criteria for investing. The reasoning is that most businesses encounter unforeseen obstacles requiring a pivot to survive and flourish. Only a seasoned team who has weathered these storms before can navigate the inevitable changes that all businesses encounter. Okay, so this chart explores the maximum amount of equity that you can sell. The chart shows the maximum amount of equity a company can sell, which is 100% of the value of the company. It is impossible to sell more than that. And a lot of people come to me and they'll say, they have a small company, it's just an idea, and they want to sell $100 million in shares of the company. This is generally not going to happen. Certain considerations need to be made in selling equity, most important of which is control. Smaller company owners especially want to maintain control of the company. This means they will generally need at least 51% of the voting rights of the company. A lesser amount could result in control if there are several other shareholders who do not vote in a block together. So 51% of what equals control. This is where the company needs to be valued comes in. Valuation of companies is not straightforward. There are a variety of methods that you can use. For our purposes today, just remember that owners and investors must agree on the value of the company in order to establish a share price. The maximum equity that could be sold for clear control is 49% of that value. As the chart shows, the greater the equity sold, the lower the owner's share. So valuation is a key component of establishing what the equity is that you can sell and what investors are willing to take. So there are some, we're not going to go into it today, but you can. Okay, so you're going to buy a company, so you need to prepare for your acquisition. An acquisition can add capital through additional borrowing in some cases, as previously stated, but can also add capital through the profits of the new acquired company. Here are some of the areas to get ready for an acquisition. Buyer investment. You, if you're the buyer, will need to put some or all the cash in the deal. This is the down money. Most acquisitions are not straight cash deals, and lenders want to make sure that the buyer has some skin in the game. External funding comes in a variety of forms, including lenders, seller financing, earnouts, and equity partner funding. Setting up the capital stack to cover the entire purchase can take some work. Keep in mind that there is a cost for capital. Make sure the purchase is worth it and will generate positive or return on investment, or ROI, when the deal is done. The acquisition team will generally consist of at least the owner, deal analyst, accountant, and your lawyer. The transition team will need to be in place to merge the acquired company into the workings of the buyer company. Integrating two companies is a daunting task, and up to 80% of mergers don't work. It's important to put together a team to make sure everything and everyone is connected. The acquisition may seem like it is just working out the numbers, but there are people involved that make the acquisition profitable, and a high degree of emotional intelligence must be utilized to make it work. Internal capital generation. In most cases, the very best capital that a company can receive is the internally generated capital that comes from profitability. Hopefully, this will be continuous and a growing stream of capital. This capital almost always is less costly than other forms of capital, but it is not without any cost. The company must put good management practices in place and constantly improve to keep pace with the ever-changing world. Okay, so here's our chart again on the basic 4 types and sources of capital. Profits create earnings for the company. Accumulated profits can be held in the company as retained earnings. Again, this is a great source of capital. You don't have to pay back and you don't have to give up equity to get. Preparation for greater profitability. Here are the most important areas for the company to focus on to develop and maintain continuous and growing capital through profitability. Product development and positioning must be maintained, examined regularly, and improved continuously. The competition isn't going to remain static, so vigilance is required to keep pace. The competition may come in other forms too, such as substitute products, new economic conditions, or social changes that may make current company product offerings less attractive. This is also an opportunity to make product offerings more profitable. The company needs a good sales system that the salespeople are trained in and follow. It is well known that success in sales depends on a good system. Marketing is more than just advertising. It should begin with research on product trends, needs and wants trends, and social trends. Constant vigilance of the marketplace and how companies' products are faring is a necessity. Great marketing can make sales superfluous. Management, consisting of strategy, leadership, teams, process, and controls, to name some of the elements, is actually at the bottom of the profitability pyramid. The basis for everything else, the starting point. Management is the engine that starts it all. What's the best path for you and your company? We'd love to hear from you. Please let me tell you about my product that explains how to identify the right lender for you. This course gives you everything you need to successfully target a business loan. Just click the link below this video to get the Laser Loan Targeting course. This is a limited time offer and it will expire in 48 hours, so click the button now to get started. Let me tell you more about this course. There is a loan out there for you in almost every case, if you know where to look and approach the lender in the right way. My Laser Loan Targeting course gives you everything you need to know to target the right lenders. With this program, you don't waste endless time and energy on dead-end lenders. You do zero in quickly on the type of lenders and loans that you really qualify for. You get a series of 3 video modules outlining your laser credit situation analysis, an explanation of the different types of loans and lenders, laser targeting of the type of lenders and loans available to you. You will learn how lenders look at your credit situation and how you stack up, what types of lenders and loans are out there, how to determine the best loan for you. You will learn the differences in lending instruments, the pros and the cons, and which are the best in certain situations. You will learn how to determine the loans you will qualify for that meet your needs. When you want a loan, here are some do's and don'ts. Do understand what loans are available to you. Do understand your credit position and how lenders see you. Do put a great loan package together. Do get help with your loan when you need it. Do contact the right lenders for your loan. Don't apply for the wrong type of loan. Don't apply to the wrong lenders, and don't submit a bad application package. Here are some false beliefs that a lot of people have about getting a loan. Number one, all lenders are pretty much the same, so all you have to do is apply and they would tell you what type of loan you need. The truth is, there are quite a number of different types of loans and different lenders for each. If you apply for a loan a lender doesn't offer, you will be declined. If you don't apply in the right way to that lender, you will still be declined. False belief number two, I have issues with my credit, so no one will lend me money. The truth is, there are loans for almost every situation if you know where to look. False belief number three, I don't have collateral for a loan, so I can't get a loan. The truth is, there are loans that don't require collateral if you know which ones. I hope it's okay with you if I spend a few minutes going over a very special offer I created to help you implement targeting the right type of loans and lenders for you. First, with this special offer, you get an explanation of loans and lenders, which I would normally charge $250 for, which is my hourly coaching and consulting charge. Next, you're going to learn all the various loan and lender types that are available to you. I charge a minimum of $250 just for this. So what that means is, first you're going to get an explanation of loans and lenders, and also you're going to learn all the types of loans and lenders available to you. Next, you're going to learn how lenders view your credit situation, which I charge $250 for. So you're going to get an explanation of loans and lenders, you're going to learn how to target loans and lenders that are available to you, and you're also going to learn how lenders view your credit situation. Next, you're going to learn how to determine the best loan for which I charge $250. So, you're going to get an explanation of loans and lenders, and you're going to learn which loans and lenders are available to you and your credit situation. And also, you're going to learn how to determine the best loan for you. Next, you're going to learn the pros and cons of different lending instruments, which I charge $500 for. So you're going to get an explanation of loans and lenders, and you're going to learn which loans and lenders are available to you, and you're going to learn how lenders view your credit situation, and you're going to learn how to determine the best loan for you. And also you will learn the pros and cons of different lending instruments. Next, you're going to determine the loans you will qualify for, which I charge $1,000. So, you're going to get an explanation of loans and lenders, and you're going to learn which loans and lenders are available to you, and you're going to learn how lenders view your credit situation, and you're going to learn how to determine the best loan for you, and you will learn the pros and cons of different lending instruments, and also you're going to determine the loans you will qualify for. With this special offer, you get an explanation of loans and lenders valued at $250. Next, you get laser targeting of the types of loans and lenders available to you valued at $250. Next, you will learn how lenders view your credit situation valued at $250. You will learn how to determine the best loan for you valued at $250. You learn the pros and cons of different lending instruments. That's a $500 value. You'll learn how to determine the loans you will qualify for, which is valued at $1,000. That's a total value of $2,500. I'm not going to charge you $2,500 that this offer is worth, but I have a question for you. Let's say I did charge you the full $2,500. Would it be worth it? If this course helped you build the business of your dreams, would it be worth it? If this course helped you save your business and your livelihood, would it be worth it? If this could take the stress out of your life, worrying about making payroll or paying bills, would it be worth it? I'm not going to charge you the $2,500 that this is worth. I'm not going to charge you $1,500 that I sell this for retail. I'm not even going to charge you the $297 that most of you were probably assuming I was going to charge. Because you're watching today, I'm going to give you a very special price of just $47. That's right, I have done all the hundreds of hours of research and work to boil the process of determining what types of lenders you will qualify for in a simple program, and it's only going to cost you $47. Go ahead, click the button below and get started. Your special pricing is only $47 for this course. But that's not all. When you sign up today, you get the following bonuses: my detailed instructions on how to get difficult business loans, and contact information for the best credit repair company I have ever found. But that's not all. As an additional bonus, if you sign up today, you get my list of 5 peer lending sites where you can get loans banks won't do, and a 15-minute call with me to review your loan, including this offer for the first 100 people to sign up. I will review their laser loan targeting tool results and provide one lender who you should qualify with. Click the button below and enroll in this program. This is a limited time offer and it will expire in 48 hours. So click the button now to get started, and I'll see you on the other side. This course is a great step to put you on the right path to actually connect with a lender that can provide a loan for you. Don't spin your wheels aimlessly applying to every bank and lender when there is no possible way you can get a loan you need from them. Stop the endless frustration and wasted time. Get the money you need to move your business forward. We can do this together. We can make the change you need in your business that you have been waiting for. Remember, every winner has a coach. Let's win this together. Thank you for attending the webinar. Please let me know what your best takeaways were and if you found value in it. If you want to get in touch with us, you can at 856-817-6231 or just send me an email to johnfazio at winning-advantage.com. We'd love to hear from you. Thanks for attending.